Good day, everyone. In this video, our group is going to be analyzing a borrowing cost case problem. More specifically, LaserWord's A Borrowing Cost Dilemma. Here is a comprehensive summary of the case.
Now imagine a company, LaserWords Incorporated, is a book distributor that has been operating in its original facility since 1995. The increase in certification programs and continuing education requirements has contributed to LaserWords' annual growth rate of 15% since 2020. However, its original facility became obsolete by 2025, which prompted the company to hire Black Construction to build a new building for 4 million pesos on land owned by LaserWorks. The following is all the information regarding the payment schedule and the borrowings related to the construction of the new building.
Now, the primary accounting issue for this particular case study revolves around PAS 23's borrowing costs, specifically concerning the capitalization of interest expenses related to construction of a new building. This involves determining which borrowing costs are eligible for capitalization, calculating the appropriate amounts, and ensuring proper disclosures in the financial statements. Accurate capitalization of borrowing costs is essential to produce a true and fair view of the financial statements, and you will see why this is important later. With that in mind, stay tuned as we delve deeper into LaserWord's borrowing cost dilemma. Let us proceed with the first question. What costs should be capitalized for self-constructed equipment?
Hello, I will be covering what costs should be capitalized when it comes to self-constructed equipment. All the information stated will be based from PAS 16 and PAS 23. So first up, what even is capitalization? Well, it means including costs as part of an asset's value and only if they help bring it to the location and condition needed for use. These include direct materials and direct labor, basically anything that is blatantly used to build the equipment. Also, some indirect costs can also be capitalized if they relate to construction and are reasonably allocated. PAS 23 indicates that interest on loans used during construction are capitalized but only during construction period. Design fees, installation, transporting materials, and etc. can be included too, as long as they're essential to getting the equipment ready for use. What's not capitalized is abnormal waste, admin costs, etc., as long as it was spent after the asset was ready. To sum it up, capitalize the necessary construction-related costs and expense anything abnormal, unrelated, or post-construction. Now, let's move on to the analysis of this case.
Moving on to our computations, we decided to break down the computations into four steps. First one being finding the capitalization rate. In order to find it, we must simply find the total interest incurred and multiply to the total principal of our general borrowings. So we have 560,000 divided by 5 million. This will give us 11.2% as our capitalization rate. For average expenditures, we listed out all the expenditures that LaserWord Incorporated incurred and multiplied it to their months outstanding. This will give us their averages and we totaled them to be 1,400,000 pesos. For step 3, we just multiply the capitalization rate and the average expenditures in order for us to come up with a capitalizable borrowing cost. So 11.2% multiplied by 1,400,000, which will give us 156,800 as our capitalizable borrowing cost. And for our interest expense, we just need to subtract the actual interest incurred by the capitalizable borrowing cost, which will be 560,000 minus 156,800, which will give us 403,200 as our interest expense that we will recognize throughout the years of constructing the asset. And moving on to the journal entries and the rationale for computing borrowing costs.
Now let's move on to why we capitalize borrowing costs. The rationale of capitalizing the borrowing cost is rooted on the core principle of PAS 23 derived from IAS 23 borrowing costs. Borrowing costs are capitalized to ensure that the cost of a qualifying asset reflects all expenditures directly attributable to bringing the asset to its intended use or sale. This treatment aligns with the matching principle, which aims to recognize expenses in the same period as the economic benefit they help generate. In simpler terms, the borrowing costs help build the qualifying asset come to be, so it's only fair to add them to the value of the said asset. According to PAS 23 Borrowing Costs, paragraph 5 and 8, the capitalization of borrowing costs is required when they are directly attributable to the acquisition, construction, or production of a qualifying asset. Qualifying asset being defined as one that takes a substantial period of time to get ready for its intended use or sale. This ensures that the asset's cost includes all necessary expenditures incurred during its development, resulting in a more faithful representation of its value. Therefore, capitalization of borrowing costs is not merely a technical requirement, but a principle grounded in the matching and faithful representation principle. Now, let's take a look at what exactly these assets are in the problem and check Laserwood's financial statements.
For the journal entries on December 30, 2025, Laserwords made a payment of 900,000 to Black Construction. To record the direct expenditure on the construction, we debit 900,000 to building, then credit 900,000 to cash. For the second entry, Laserwords had a note payable with interest due annually on April 1st. To record this transaction, we debit 50,000 to interest expense, then credit 50,000 to cash. This is calculated by 2 million times 10% interest rate multiplied by 3, which indicates the number of months from January to March, then divided by 12 months. On August 31, 2026, for the second payment, we debit 1.5 million to the building account, then credit 1.5 million to cash. The final payment for the new building on December 30 is recorded by debiting 1.6 million to building, then crediting 1.6 million to cash. At this point, all direct construction costs have been recognized in the building account. The annual interest payment on Laserwords' 12% 10-year bond issue is then recorded by debiting 360,000 to interest expense, then crediting 360,000 to cash. The calculation for this is 3 million times 12% interest rate. By December 31st, the interest due on April 1 have been accrued. From April 1, 2026 to December 31, 2026, a total of 9 months, interest has been incurred even though it hasn't been paid yet. To adhere to the accrual basis of accounting, Laserwords must record this. Therefore, we debit interest expense and then credit interest payable to represent the amount owed to the note holders. The calculation for this is 2 million times 10% times 9 divided by 12. For the last entry, to record capitalized borrowing costs at completion, we debit building by 156,800, then credit interest expense by 156,800. For the disclosure, during the year ended December 31, 2026, Laserwords Incorporated capitalized borrowing costs amounting to 156,800 related to the construction of its new building. The capitalization rate used to determine the amount of borrowing cost eligible for capitalization was 11.20%, based on the weighted average rate of general borrowings. The building qualifies as a qualifying asset as it required a substantial period to prepare for its intended use. Following the borrowing cost capitalization analysis, we now proceed to conclusions and recommendations for enhanced financial reporting and compliance.
In this case study, we help Laserwoods Incorporated apply PAS 23 in treating borrowing costs during building construction. We determined that the standard applies here because the building is a qualifying asset. Capitalization commenced on December 30, 2025 when the necessary conditions were satisfied and ceased on December 27, 2026 when the building was ready for occupancy. Subsequently, we computed the capitalizable general borrowing cost, which amounted to 156,800. The treatment presented in this study ensures that Laserwoods Incorporated's financial statements fairly reflect the true cost of the asset and avoid the misstatement of expenses, thereby promoting faithful representation and compliance with PAS 23. In light of these findings, we therefore recommend the following measures. First, align construction planning with financing strategy. This can be made possible through timing construction activities to match the use of borrowed funds, which allows more borrowing costs to be capitalized, reducing short-term expenses. Second, implement a capitalization policy with materiality thresholds. This can be carried out by setting guidelines to determine when borrowing costs are significant enough to be capitalized for consistency and simplicity. Third, maintain transparent disclosures to build stakeholder trust. This can be executed by clearly explaining borrowing cost treatment, capitalization criteria, and key assumptions. Finally, review with auditors to ensure compliance with the applicable framework. In this manner, proper standard application is ensured and risk of restatements are reduced.